Known as the most famous man on Wall Street with almost 4 decades of experience in the New York Stock Exchange.
An unsuccessful trader will have no plan. They'll watch it go to 51. They'll think, oh my God, it's going to 55. They'll never take a profit. They go get a coffee. It's trading at 48. They buy more. It goes to 44. They can't take the pain anymore. They sell it. The stock goes back up $8. They blame the market maker.
Introducing Peter Tuchman, also known as the Einstein of Wall Street. In this episode, we explore not only exact strategies for profitability, but also the history of the markets itself, what it's like trading on the New York Stock Exchange on the trading floor. This is a must-watch episode for any trader who wants to make it within the markets, to learn from somebody who's been doing it for decades, a professional trader with verified results lasting the test of time.
Information is a funny thing. I, as a broker on the floor of the stock exchange, have access to information called market on close imbalances. What does that mean? That means there's a birdie who once told me that if you put $250 a month into the S&P 500 from the age of 22 till you're 60, you will have $1.3 million. The 60-year-old thing may not be that sexy, but $1.3 million is very sexy.
Certain traders would believe that the market is operated by a central algorithm and that price is delivered, price is engineered, and that there's higher powers, let's say. Is there any element of truth in that?
Yeah, I don't believe so. So look.
Ladies and gentlemen, welcome back to another episode. We have the honor of being joined by the Einstein of Wall Street. Peter, thank you very much for joining.
My honor, thank you, sir.
You've given us a moment of your time in a busy schedule for the summit,
sure.
New York to Dubai. So I want to take this episode directly to value. The audience that we have are retail traders that are looking to learn. And I want to take this opportunity with the unique background that you have, being from the Wall Street, the stock exchange, and traditional finance. I want to start off with retail traders in my generation. We are obviously looking to social media to learn, and a lot of YouTube videos and so forth, platforms like this. And one of the most prominent, I have to ask, one of the most prominent things that traders end up at is this concept of smart money concepts, an ICT. When it comes to traditional finance, Wall Street and so forth, is this a term that you're familiar with?
I've never heard of it. I don't know what that is. What is ICT and what is smart? Tell me.
Good to know. I mean, it's a school of thought that has been around for maybe a decade or two.
Okay.
That is probably the most viral way that traders are looking to learn because it has certain benefits of high risk reward and so forth.
Okay.
But it's good to know that you're none the wiser, because I think that says a lot in itself.
Yeah, no, I mean, if you would describe it to me, what does it actually mean?
It's certain parameters would be an order block within price action, an imbalance or a fair value gap, liquidity runs, these kind of price action terms that traders are utilizing to mark the charts.
Wow, spectacular. So, I've learned over time that I have a pretty big presence on social media, and, I don't actually listen to a lot of social media around trading, even though I do a lot of it. It's like I don't, many of the people who are involved in it, I don't listen to. I don't know who they are, not for any level of disrespect. It's just I'm too busy. My way is different. I've learned that my way, look, a lot of that terminology, I don't know the words and they don't mean anything to me.
Sure.
When I deal with retail, so I have an academy with my partner, David Green, called Wall Street Global Trading Academy. We have thousands of students from all over the world, and they will often talk to us and ask us questions about like the iron condor and all these wild, I guess, trading strategies within social media of today, and it's not our wheelhouse. We don't know anything about it, and so we are more traditional, I guess, or it's terminology that I'm just not familiar with.
So there's another thing that could be part of it, is that obviously to stand out in the social media game, you have to reinvent marketing and so forth.
Right.
So it could be similar things that are just termed differently. So we can navigate this, where when it comes to the markets, when I look at the stock exchange or currency and so forth,
right.
Certain traders would believe that the market is operated by a central algorithm and that price is delivered, price is engineered, and that there's higher powers, let's say. Is there any element of truth in that?
Yeah, I don't believe so. So look, there are a lot of misconceptions around in the retail world about bad players in the game. The man is out to get you. The whales are here to hurt the retail trader. Market makers are bad people. They will take a stock down to your stop order and then rally it back up and kind of screw you over in a way. I'm a firm believer, and I mentioned it this morning when I spoke, that when people are successful in the day trading game, you will never hear them blaming anybody else for their success. They will love to take credit for it, that they have diamond hands, that they're the best traders and whatever. When people are unsuccessful trading, they love to blame everybody but themselves. They will blame the market maker. I will ask, one of the big positions, the postures that we take is about risk management, money management, order management. Stop orders, right? The stock exchange has given retail traders this incredible tool called a stop order. What does a stop order mean? That means that I'm able to identify how much risk I'm willing to take in the market. For example, I buy 100 shares of XYZ at $50 and I put a stop order in at 49.5. We believe that 1% of the price of the stock is a good price. It's identifying how much am I willing to lose for this trade, right? So when it comes to risk, am I willing to risk $50 to make $200 all day long? Am I willing to risk $200 to make 50? Well, no, I'm not, because net, one losing trade, it will take me 4 winning trades to break even. So I'm always chasing failure. Okay, so one of the biggest misconceptions, and I've dealt with market makers. My partner was an ex-market maker in Bank of America and IBM, right? And I've been on the floor for, some say, 137 years, right? I'm on anti-aging medication, so I just look this young. And I've dealt with market makers. I've dealt with traders. I've been on all different sides of this market, right? I started in 1985. I've been a retail trader, an option trader, a convertible arbitrage trader on the floor. I've done risk arbitrage. And throughout all this time, up until recently, I'd never owned a share of stock for myself. Okay, a little known fact.
Okay.
Reason being that as a registered broker on the floor of the New York Stock Exchange, who has a seat on the floor of the stock exchange, I am not allowed to be in a stock for myself personally and for a customer within a 30-day period.
Because of insider information regulation.
Correct, exactly.
Okay, understood.
So with that being said, I built a strategy 16 years ago around trading market on close, and I'll be happy to explain to you that.
Of course.
But I trade all 347 stocks that are in the S&P 500 on the floor of the New York Stock Exchange. So in the S&P 500, obviously there are 500 stocks. 347 of them are on the NYSE. The rest are on NASDAQ. Reason being that back in the day, right, there were valuation issues, and a lot of the new startups and a lot of the new tech did not have the valuation warranting a listing on the NYSE. Their valuation needed to be 250 million plus. I'm not sure the exact numbers. And so they went to NASDAQ. NASDAQ's rules are a lot more lax when it comes to capitalization and the ability to list an IPO. So that's why you'll see the Netflix and the Amazons and the Nvidias and those listed on the NASDAQ over-the-counter market as opposed to the NYSE. So
I want to explore. So you've been, well, I guess next year is your 4th decade completed on the New York
Correct.
Stock Exchange. So you've been around in the game a lot longer than most of the viewers that I have. I'm only approaching my 1st decade in the markets. And so therefore I haven't seen full market cycles and the ups and downs that an economies can have.
Right.
And I think in your time, we've had the crash of 87, we've had the dot-com bubble, we've had the crash of 08, we've had COVID.
Yes.
We've had quite a lot of turmoil, and it seems like they are rather cyclical. And with everything that's going on in the world, with the prospect of wars and all these kind of things, how do you see the future of the US, the future of the markets, and any future crashes that could be coming, or how to even navigate these kind of situations?
I appreciate the question, a great question. First of all, it's important for me to note that I don't use the word crash very lightly. The terminology that is historically used in the stock exchange, in the financial business, like recession, inflation, the death cross, the yield curve, bull markets, bear markets, are no longer relevant in my belief, in my world. Okay, the world changed during COVID, right? I don't think for the better. Okay, I was basically patient zero at COVID. I got COVID on March 15th, 2020. Wow. I was incredibly sick. I had 103.7 for almost 3.5 months. I got meningitis. My cervical spine collapsed. I've had 7 surgeries since then. I was in a neck brace for the last 4.5 years, up until recently. So, and I was given 4 days to live at one point during my journey throughout this. So it changed my life and ruined my life in lots of ways. But I'm a survivor, so I kept going. What happened during, so if you imagine the stock market and the financial industry and the economy as sort of like, when you're a little kid, your dad gives you a 20-piece jigsaw puzzle, and then as you get better, as you get smarter, you get a 50-piece puzzle and a 100-piece puzzle, right? So if you think of the stock market like that, the components, all the different things that happened in COVID dismiss the relevancy of so much that we historically call the standards of Wall Street. Okay, you cannot use a term like a bull market and a bear market that you understand as something that happened within the economic cycle of a decade or a generation or whatever it is, when in January of 2021 at 11 in the morning on January, I don't remember the day, I think it was the 23rd, in the morning we were down 1,400 points at 11 a.m. And the press was talking about, oh my God, we are now in a bear market, the first bear market historically. A bear market is a 10% drop from the last sale and for an extended period of time. I'm not even sure the actual definition of one. And then the market reversed. And by 2 o'clock in the afternoon, we were actually in a bull market. Right. And so when you have something that historically used to take generations to happen, right, now happening over lunch, well, you need to reevaluate these things, especially when, people use them in such a significant way that these are economic cycles. These affect markets. They affect how people invest in the market. They explain the economics of our country. I mean, it suddenly went at COVID to a 1,000-piece jigsaw puzzle with so many different components that, the world's changed since COVID. And I could describe to you in detail. Fortunately, I have a photographic memory. But if we go back to I'll go back to February 12th, 2020. The markets were trading at record highs across all indices. Okay, February 12th was the day because that was the top. That was the high. The Russell, the S&P, the Dow, the NASDAQ were trading at record highs. The consumer was in incredibly healthy condition. The banks were the bank's balance sheets were incredibly robust and healthy, and everybody across the board was doing quite well. Little did we know that 6 weeks later, the market would have sold off 10,800 points. People would be dying in the streets, and that the market would careen off of a cliff, and we would be entering a global pandemic, which changed the world forever. Okay, so that left us from February 12th until March 23rd, which was the cliff dive. Okay, and everything changed that day, right? Everything about the market, everything about our lives, everything about the economy, everything about everything, right? Suddenly, and it was, look, every crash, and I use the term in a serious fashion, going back to the crash of 1929 has been net a better buying opportunity and selling opportunity. Every one of them, every crash. And there've only been a handful of crashes in history. Going back to 29, right? Going back, and I don't know that much about, the World War II and all that time. It was a different time, and we don't need to go there. There's plenty to describe and talk about between then and now. But the crash of 80, and I was there for all of them except the crash of 29, even though some people believe I was around for that time. Some people believe I signed the Buttonwood Agreement, but that was not true.
So out of the dozens and dozens of prop firms that exist in the whole space, who can we really trust? Whether they use slippage, whether they use types of drawdown, unrealistic trading conditions, every single prop firm has hidden tricks. So after thorough research and speaking to a lot of traders, Alpha Capital is definitely the best prop firm in the space. So apart from their no commissions, low spread, no slippage, great reputation, never denying a payout, because you are a Titans of Tomorrow viewer, you get a special discount on every evaluation just using the link or using the code TOT for Titans of Tomorrow.
So there was a crash of 87, and people should know, and I hope your audience does this research because history is powerful, and history really explains a lot of where we are, and I don't need people to dwell on it. But in order to understand where we are in the economic cycle and where we are trading and investing, it's really, and to have an overview and an overall perspective of what's going on, it's important to know the history. And I'm going to give it to you in just in as short a way as possible. But so February 12th to March 23rd, the market sold off radically, okay? The crash of 87, each one of these crashes has had different components that made them happen. Okay, I don't need to go back to 29, but the crash of 87, we were coming off of a record high in the market. There were some insurance issues. There were a lot of different components. It's long for me to describe each one of them, but people should investigate it because each crash, 87, 2000, COVID, what was in the middle, and the dot-com bubble,
yes,
right? Each had very distinct components that contributed to the crashes that happened later on. 87 was an extraordinary time, percentage-wise, the largest sell-off in history. Okay, and I was there. I was trading it. I was a clerk. I started on March 23rd, 1985. I came down to the floor of the stock exchange as a teletypist. There was no training for that job. Okay, there's no school you can go to become a broker. Everyone's goal when they come down on the floor of the exchange is to become a broker. That's the dream. In 1903, they issued 1,366 seats on the stock exchange. That gives you the right to trade stock. And the seats on the stock exchange, it's like a taxi medallion in our world. They've got the price of them goes up and down, no longer because the company went public and it's a different story now. But the price of a seat went up and down, and it used to trade actively on a daily basis, going back to 1929, back into 1903, based on the economy, based on the markets, based on the demand for traders and brokers on the floor of the stock exchange. The crash of 87, extraordinary because I remember it really well. I was still new, and I remember it was the beginning. So computers came out around 1983. They were not on the stock exchange until way later. But what was available on the stock exchange in 1985 and 1987 was a thing called a Quotron machine. A Quotron machine was a static TV teleprompter type thing. And there was also a machine that called a dot machine where orders were coming down electronically in print, very archaic, right? It was like the old clunk, 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 right? But the orders were coming down. And that day, 1987, the market sold off 683 points, 30-something% sell off, net based on where the market was, right? We obviously know percentage based on where the Dow was. It was the biggest crash. But my memory of it was extraordinary. I was a clerk, so I started as a teletypist. I came down there, right? My career, my life before that was an extraordinary one. I grew up in New York City. My parents are Eastern European Jews. They were in the Holocaust. They spent 4 years in prison. They met after the war in a displaced person camp, fell in love, came to America, had a couple of children. My father was a very famous doctor in the U.S., and I grew up on the Upper West Side of New York with every possible unconditional love and a wonderful upbringing, right? And so I had a wonderful early years. I ended up going to college. I, at one point in my life, wanted to get into agriculture. I graduated high school early. I ended up going and living in Israel for a year. I wanted to work on hybriding of plants, and I did. I ended up coming back to the States in, I don't remember the year, 1970. I came back to the States after my year in Israel and got a degree in agriculture at the University of Massachusetts, one of the top ag schools. And after 2 years of that, I have a brother who's now who my father adopted during the war. He's in his 90s. He's still alive. My father lived to 97. So I have an older brother who was a major player in the stock market. And he ended up, so my father adopted him during the war. His parents had been murdered. He was 8 years old. My parents met. They fell in love. The United States only allowed 40,000 children in after the war. It cost $50,000 per child to come as a refugee. All right. My grandfather was the CEO of Suchard chocolate before the war. And so he was a very comfortable, wealthy man. He was able to pay for this young man, his name was Harvey Katz, to come to America after the war. He got foster parents. My parents met. They brought him to live with them. He went on, to make a long story short, he went on to become a major titan on Wall Street. And so after my 2 years as an ag student, my older brother, we called him my older brother, said, enough is enough. It's time for you to put on your big boy pants and get into finance and and go to the stock exchange. And so that's what I ended up doing. I got a degree in international finance. I moved back to New York. I owned a record store on Bleecker Street. I had an African art gallery. I was booking jazz concerts all over the world. I was the doorman at Studio 54. I was trading.
You did a bit of everything.
I was trading commodities, and I was getting a master's in business at Baruch College. I say all this to say that I've had this incredible journey all around. I ended up living in West Africa for 2 years in the People's Republic of Benin, where I did the accounting for a Norwegian oil company. I came to Wall Street in 1985. I was 26. I had already lived a few lives, right? But I think I was a young entrepreneur with a real hunger for chaos, adrenaline, excitement, and what Wall Street ended up offering me, which was when I walked onto the floor of the stock exchange, the chaos, the excitement, and this incredible dynamic. Actually, I felt I had arrived, and I was in a place that your audience, obviously, they're involved in the market now because they got that feeling, right? Every day for me is like being in the Super Bowl, right? There's nothing better, right? What draws people to the New York Stock Exchange, for one example, or draws people to trading, right? And that excitement, the adrenaline of trading a market, being in an auction market and making money in the market. It's an extraordinary, it's like no other feeling in the world. Making money doing it is extraordinary. Losing money could probably be one of the worst feelings. And I'm giving you this whole scenario because I need people in your audience to understand that there are certain rules. This is where this conversation started. You asked me, are there some misnomers about what's going on? And one of the biggest ones is that people think that market makers on the floor of the stock exchange are out to get them, and that they think that they see their stop orders and that they take the stock down, they take them out on their stops, and they let the stock rally back up. The biggest misnomer on earth, right? And so I also started out this conversation by saying successful traders don't need to blame anybody but themselves for making money.
Yes.
Unsuccessful traders love to blame anybody but themselves for losing money. And at the end of the day, one of the reasons I've embarked on this journey to educate, motivate, inspire the new generation, your audience, to become great traders is because suddenly all of you young people in the investment and trading community who got invited to this party that you were never welcomed at up until 2020, right? During COVID, Webull, Robinhood, suddenly, before all that, you needed to be an accredited investor to day trade or invest in the stock market. That meant that in order to open up a trading account, you had to prove that the money you invested or trading or that you were trading with, if you lost it all, would have no effect on your standard of living for 5 years. Nobody but the 1% of the 1% could ever say that. I couldn't say it, right? So that kept it very exclusive. That's why very wealthy people are the ones who are in the market. For me,
this term, so you mentioned a lot of things. One thing I want to latch onto is obviously the retail traders and their composition in the market is probably a drop in the ocean in terms of the orders that they have. A lot of trading strategies around this day and age, at least, a lot of retail traders that are watching utilize liquidity and terms around that. Obviously, in the stock exchange, you have access to the books, you have access to the orders. Does any form of manipulation, any form of liquidity have an effect in the markets? As you're saying, it's not necessarily the market makers attacking, but is the manipulation of orders or spoofing, these kind of things, something real?
Good question. So look, there always are going to be bad actors in any space. There are bad actors on social media, those who are doing the pump and dump, those who are doing the, who are like the Jordan Belforts of the world. That those people do exist. That was real. The Ivan Boskis of the world, people who come into the market and manipulate the market, right? The floor of the stock exchange, fortunately, has never been a place until Jordan Belfort was a place where a lot of that fugazi stuff, I'll use that word, really went on. But I don't want the retail trader to think, first of all, that the big players, the institutional players, the hedge fund people are out there trying to manipulate the market to hurt the retail trader. By nature, by the size of what they're doing, they move the market. Are they sitting up there rubbing their hands together, right, with pointy ears and, planning to go screw everybody over? I don't believe that at all. The market makers are not out there to hurt the retail trader. I don't think by nature, the size of their order flow and the connections that they have, obviously they have access to more information, not inside information, just more information. Information is a funny thing. I, as a broker on the floor of the stock exchange, have access to information. Everybody who has a seat on the stock exchange has access to information called market on close imbalances. What does that mean? That means that the order flow coming in, okay, I got to go back for a minute. The New York Stock Exchange used to do 80% of all the volume traded on the US markets back in the day. Now we only do about 35% of that because they deregulated the trading platforms and the market making community, so that basically anybody who can create a platform, whether it's a dark pool or whatever, where if you get a buyer and a seller, you have a marketplace. And they kind of were a little bit lax about the way they set up the rules. So I think there are now probably 70 different trading venues that people can go to. Okay. If someone goes to those venues and they get disadvantaged, it's not the platform's fault. It's because what they're doing is they're trading. Look, all you need is a buyer and a seller to have a market. Okay. If you want if you want no disadvantage, if you want clarity and liquidity in the market, you have to go where that exists, and that exists on the floor of the stock exchange. Okay, we, the people who trade on the floor of the exchange, the market makers, the brokers, and the people that are the where the order flow comes from are not bad people. They are not there to manipulate the market and to screw the young retail trader. All that being said, it appears that I'm one of the only ones of the old guard who has taken it upon themselves to include the young new community, because that's who I am. That is, a lot of the brokers who I grew up with, right? And I don't consider myself an old timer. I consider myself a long timer. But a lot of the people who came up in the guard with me have retired. They've moved on. They never made it past the old open outcry paper pads.
Yes.
When the technology changed, they left and retired. I almost did. I was the last broker on the floor who gave up his pad when they said to me, Peter, if you don't give up your pad and take the handheld computer, you will not be able to trade on the floor tomorrow. And I surrendered to the story because my story wasn't over yet. And I had a lot more. I also had, I knew there was more that I wanted to do. So, this is a very big story, the answer to the questions you're asking, that big play. So, there are multiple trading platforms. There are some are thinner than others. Some don't have the liquidity that people would want, right? Retail traders should know to go where there are. So, okay, NASDAQ and the NYSE. NASDAQ is a trading platform where a lot of the tech stocks went, as I said in the beginning of the conversation, because of the capitalization issues. Okay, there are no market makers on NASDAQ. NASDAQ is a strictly electronic marketplace. So in the absence of public buying or selling, the book is very thin. It's very empty. You may go try and sell 1,000 shares of Amazon on NASDAQ's marketplace. And if there's no public there to buy the stock, and you send an order through the system, a market order, that's an order without a limit to it, it's going to go until it finds a bid. Now, it may be down $1, it may be down $5, right? We've seen those things called flash crashes. A flash crash is a time where somebody hits a bunch of buttons to try and dump stock. They're just, maybe people were at lunch with these things, and so there was a huge gap in the liquidity of that stock at that time, and the guy sold it down $9, right? And suddenly they think, I just got screwed. Sorry to use that language, but not necessarily the case. That's the nature of the NASDAQ marketplace. Yeah. The New York Stock Exchange, which is what differentiates us in the most wonderful way from all other markets, is we have market makers. Market makers' jobs are to create a smooth and active market. Market makers' jobs are to inject liquidity into the marketplace. They are there. We have parameters, right, on the stock exchange. Okay, in the absence of public buying, the market maker has to buy it. In the absence of a public selling it, the market maker has to sell it. They don't have to stand in front of an oncoming train, but they have parameters where they have to be involved.
Interesting.
Okay, and those guardrails, you ever gone bowling and they've got those things? Okay, those guardrails are set by the SEC and the stock exchange.
Okay.
They are to protect the public from lack of liquidity in a particular stock. Look, at the end of the day, when news comes out in a stock and all the buyers suddenly evaporate because it's bad news, and somebody comes in and they want to sell stock because they see the market selling off and there's no one there to buy it, on NASDAQ, it may gap down and they may end up selling stock at a disadvantage and lose $5. And suddenly they think that the world's out to get them, when in fact, it's unfortunately just the nature of trading on NASDAQ.
Super interesting.
If they are to come and trade on the NYSE, we have a 7% rule, which means that if there are no public bids down 7% and the market itself or the indice itself or the stock itself trades down 7%, we go into slow mode. All right, the electronic systems that we use now to trade will slow down to protect the public. Again from an onslaught of sell orders. That 7% slowdown is there to identify, is there news out? Was that a fat finger? Why is the stock trading down so aggressively? And where are all the buyers? And we go slow so that it's the fiduciary responsibility of the market maker to do the best, not for himself, but for the retail trader. At 10%, we go into stop mode. If you'll remember, during COVID, we had a number of days where the market actually opened and closed on the same tick, because pre-market, the market was already trading down more than 10%. Now, if you remember that, it was probably late March, early April, beginning of May, where we had that week where the market we traded 24 hours a day now, right? We know that. The SPY, the NQ, a lot of these indices will trade around the clock. And so when there's bad news that the world's coming to an end, and everything is really, and people are dying in the streets, well, everybody wants to sell. And pre-market and aftermarket markets do trade. So if you wake up in the morning and the market's supposed to open at 9:30 and the S&P 500 futures are trading down more than 10%, then we open and close on one tick because we have to, because the guardrails are 7% we go slow, 10% we stop trading. At 10%, stopping trading gives everybody a chance to figure out what's going on. Is there bad news? Do I really want to sell my stock down 10%? Where are the bodies buried? what's really going on.
Interesting.
And it gives everybody a chance to also step in. Now, somebody who has an order to buy 100,000 shares of XYZ at $50 and it's trading at 54, and suddenly there's bad news out and COVID comes and 50,000 comes in to sell and it hits the market and it's about to trade down 10% because there's no public buy interest, right? And the market stops trading because it's going to trade down. It doesn't stop trading after it trades down 10%. They will stop trading when it's going to trade down 10%. That gives an opportunity for people to be wakened up to the fact that the market's about to trade down big. And if you have an order anywhere from 50 to 40, you may want to put your order in there, right? So I'm trying to paint you a picture where the stock exchange itself, the NYSE, and I can only speak for the NYSE, and I don't speak for the NYSE, I speak for my experience, is that my experience is that they do everything in their power to protect the retail trader, the institutional trader, the newcomer, right, in the best way possible. So I don't want people to ever think that it's a culture to screw the little guy. It's not. If someone gets disadvantaged, there's probably some recourse for it.
I think it comes back to the blame thing. You said that losing traders would rather address and point the fingers and scapegoat something else than
but themselves.
A conspiracy figure. It's very interesting that we got this clarification. As a trader, it's very simple. You have to find an edge and then you have to have a mind so you can follow that edge. But how do you know if you're performing correctly or not? You have to know your data. And TradeZeller is going to show you everything that you need beyond the surface level win rates and performance and equity curve. It's going to show you detailed reports. It's going to be your backtesting tool, strategy testing tool, playbooks, notes, and it's going to be a full journal. It makes your journaling easier, faster, and more meaningful. Whereas if you were just documenting on an Excel spreadsheet or taking screenshots on your iPhone, you wouldn't be able to pull out the data that you need. The correlations that the AI within TradeZeller is pulling out for you. There's so much variety and utility within the software that I think it's essential for any trader. So the link somewhere below is going to take you directly to the TradeZeller website. I'm not getting paid. This is for you. If you want it, if you like it, go ahead and explore it, and probably you'll be using it for years to come. I want to also understand, because you were talking about crashes that happened in the past and maybe other iterations of the word. But right now we can see there's been a rally. We're at extreme highs. Obviously, then after the elections, the Trump rally. So gold, the stock exchange, even crypto is at highs. When you mentioned when there's blood on the streets and the market are at the lows, it was actually a better time to buy than sell. Correct. Now in the flip scenario, when the market's at the highs, how do you prepare yourself? Okay. So in order to answer that question in a responsible fashion, I would like to give you a quick synopsis of 2020 till now and then go over 2024 for a minute because it's significant. So as I described, February 12th, records highs across the board. March 23rd, records trading at their lows after the crash of COVID. The Federal Reserve is given the tools by whoever to use the ability to print money in order to even out or protect markets, economies, and whatnot. During the financial crisis of 2007, when we needed to bail out AIG and the banks and Lehman went bankrupt and all that kind of stuff, the Federal Reserve, in order to prevent a complete crash of the market, printed $800 billion, and put it into the market over an 18-month period of time to backstop all of the companies that were going to crash or go out of business or go bankrupt. It took 9 years for the market to get back to even after that injection of liquidity and after that crisis. When COVID came along, the Federal Reserve was confronted by a situation they had never seen before. The world was confronted by a situation they had never seen before. And they, fortunately, in my world, they learned from the mistake of 2007 because they ended up printing $3 trillion, injected into the market over 3 months because the difference between the financial crisis of 2007, right, was so significantly different than the COVID crisis that it warranted that kind of severe and aggressive
posturing in order to protect the country and the world from going under. If we did not do that, and this is not a political statement at all, I'm a firm believer that if Jay Powell did not print $3 trillion and backstop the market and get us in a way shorter period of time, in 3 months, we were back to even in 3 months. Okay, think about that. March 23rd was the crash. $3 trillion got thrown into the marketplace to bail out everybody, plus stimulus and whatnot. By August 19th, we were back to even. And the market was up 20% in 2020. It was up 28% in 2021. So we did not. Now, I'm a firm believer that if we did not do, they did not do what they did, that we would all be on bread lines today.
Oh, wow.
And it's not a political statement, right? I believe that's reality, right? Because if you think about it, it's a way different story. The crash of 07, 08 was a predatory lending environment where bad guys were selling bad products to people who could not afford them, right? And right, I mean, everyone should read about it because it's a fascinating story that they tried to sell credit in houses to people who couldn't afford it, promising them that the market was going to go up and they'd be, don't worry, you're not going to have to pay it back. The market's, by the time you need to pay it back, the value of your house is going to go up and blah, 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 all that kind of, they sold them a bill of goods, which was a lie. The market did not go up. They all defaulted. Yes. So what did they do? They sort of put they ended up with a lot of bad debt, right? Morgan Stanley, Goldman Sachs. Yep. And so what did they do with it? They had to offload all this bad debt. So they put it in a nice box with a ribbon and they sold it to someone else, 50 cents on the dollar, right? Some bank in India, some bank wherever it was. Right? They took it. Anybody in the industry will buy something for 50 cents on the dollar. So when they got that box, pretty little box with a bow, and they opened it, they said, oh no, what did I do? This isn't even worth 50 cents on the dollar. I just bought a box of, right? What do I do with it? So they turned around and sold it for 10 cents on the dollar to some unwittingly poor person, right? And that kept going down the line until someone at the end opened the box and blew the story to the world that, wait a minute, they just did this predatory lending and they just crashed the world's economies, right? And then on top of it, they were selling credit default swaps against it. It's like if I buy insurance out on your life and I poison you. That's what they did, right? Isn't that what Goldman Sachs did? They bought insurance against everything defaulting. And then they were making it default. Yep. That's the crash of 07. Let's go back to 2020 for a minute. So we were in a way worse situation. People were dying in the streets. It was not an American thing. It was a global thing, right? And suddenly we had the world coming to a complete shutdown. People were not getting on planes, trains, and automobiles. People were not going to Macau to gamble. People were not going to school. People were not going to work. People were not cutting down trees to build houses. People were not exploring oil to put on planes to go fly around the world because nobody was getting on planes. The whole world came to a screeching halt. It's hard even now to imagine that we did that. We lived through it and it happened. So in order to do that, and I have a lot of respect for Jay Powell because if he didn't have the foresight to do what he did, we would all be on breadlines today. The whole world's economy would have collapsed. Wow. So I'm a fan and it has nothing to do with politics. I just know that's my gut feeling. It's my opinion. Okay. So we put $3 trillion into the market over 3 months, back to even by August 19th, up 20% in 2020, up 28% in 2021. And then we came to 2022. With all of this printing of money and COVID and nobody going to work and the whole world coming to a stop, suddenly we had inflation. Everything cost more. People didn't want to go to work. Yep. But it was not a result of Joe Biden or any of these other things, a result of COVID and the printing of money. It was a perfect storm in a way. Okay. The only way to deal with this rise. How do you curb the inflation? You have to take money out of the money supply. How do you do this? You raise interest rates, because up till then we had zero interest rates. NVIDIA, Microsoft, whoever was doing R&D, whatever, was able to borrow money for free. Anybody would happily borrow money for free if you're offered it, right? You can pay it back when you're ready, and you don't have to pay any interest, okay? In order to take money, so they just put all this money in the system. We ended up with inflation. How do you combat inflation? One of the tools the Fed has is to raise interest rates. All those companies are less likely to borrow, right, at that price, and suddenly all the money is being taken out of the system. And that's a tool the Fed has to curb inflation. And what do you know? It worked. They raised interest rates 18 consecutive times until we went from 0 to 5.5%. And we were able to get inflation down from 8.5% to 2. It was a perfect work, right? Shout out to Jay Powell. Pow, pow, pow. Amazing. Okay? And this isn't political. This is basic friggin' economics. I don't even think I passed Econ 101. But it's just I needed to understand this to be able to do what I do now. I needed to understand why the market is where it is and does what it does. Because it's a new world. It's not, I can't use the analysis and my knowledge of past things, because as of COVID, the world changed. 1,000, the puzzle went from being a 500 piece to 1,000, and a very weird puzzle. A lot of weird colors, a bunch of funny shapes, right? All that stuff. So 18 consecutive interest rate raises. Now what do we have to do? In order to do that, we have to start, we have to decide how to combat that. And that takes something about cutting interest rates. 2022, right? When you raise interest rates to that level, it's going to put pressure. It's just basic economics 101 on the market. So after two amazing 48% rally in 20 and 21, the market had to take a pause. It had to sell off. That's just the nature of markets. It wasn't a crash. It was a pullback.
Yes.
It was a normal, so that catastrophism that everybody talked about at the end of the world, no, it was the normal cycle of a market after a 48% rally, major inflation, and all that stuff. 22, we sold off. Now, what people do, and it's happening a lot now, is people don't understand that markets go up and they go down, right? I do a lot of Fox TV, and Neil Cavuto, one of the big guys, a very close friend of mine, he always asks me, he says, Pete, you've been down there a long time. Is the market going to go up or down? And I say, yes. I'm the only guy who tells the truth. The market's going to go up or down. Yes, that's what markets do. In 2022, that's what it did. After 48%, it's going to sell off. Then we come into 2023, okay, and they said, okay, we're going to have 7 interest rate cuts now in order to stabilize all this craziness that we just went through, right? And then we started looking at payroll, unemployment, all the other components of economies and markets and all that stuff. And we realized that we don't need 7 cuts. We maybe need 5 or whatever. 2023 was the 2024, sorry. 2024, the first quarter of 2024 was the best first quarter since 1995 or something, okay? The rally that happened in the first quarter of 2024 was an extraordinary one. It was offshoot of 22, they sold them off. In 2023, the market rallied beautifully against all odds, because the press was saying that we're going to have a recession, there's going to be a depression, markets can't handle this. We just had up 48%, down 20%. The economy's not in as good shape as we think it is. 2023, the market was solid. It was up double digits. It did its thing. It was beautiful. 2024, we came in and they thought we were going to have a lot of interest rate cuts to stabilize the market. The first quarter was so good, we realized we don't need those cuts. Cutting interest rates is like pouring gas on the fire. The market was doing really good on its own. Then April came along. April came along because we had a normal pullback in the market in April. So the first quarter of 2024
Yes.
was the best quarter since 1995. April was a normal sell-off. Think about this. NVIDIA was trading at $108 February 2023. February 2024, NVIDIA was trading at $925. That's crazy. That didn't happen back in the old days, right? So April was a pullback. And I'm saying all this, and it's a long story, I know it is, but what I want people to understand is when markets do what they did in April of this year, I can count on one hand how many pullbacks, consolidations, sell-offs we've had in 2024. There have been 5, maybe 6. Those have been better buying opportunities than selling opportunities. The retail broker should know that when we have, nobody wanted to pay $924 for NVIDIA in April, in March, at first quarter. And when April, it sold off 250 points, they didn't want to buy it because their idea is, oh my God, if it's down 200, we must be in a crash. The media was telling them too.
Yes.
We must be in a major sell-off. It's the end of the world. Dogs and cats living together. It's going to be crazy. When in fact, that was one of the best buying opportunities of all time. Retail traders should know from an investment point of view that April of this year, July of this year, August 5th of this year, the Black Monday in Japan, the first week of September of this year, and October 5th, that's 6 times, those were all gifts to buy stock. Everyone should have a retail day trading account, and everyone should have an investment account long term. There's a birdie who once told me, and I'm not a financial advisor, that if you, as a young 22-year-old, put $250 a month into the S&P 500 from the age of 22 till you're 60, you will have $1.3 million at the age of 60.
Compound interest.
The 60-year-old thing may not be that sexy, but 1.3 million is very sexy. Okay? People need to change the whole psychology. Your audience needs to understand that they need to invest in stocks and not stuff. Think about all the money we waste on stuff, on buying stuff on Instagram. Everything that we buy, that the minute we buy it, it goes down in value. We really need to evaluate whether we need that stuff. Think about it. If I put $250 a month into the S&P from the age of 22, I'll have passive income. I'll have $1.3 million.
Powerful.
$250 a month is what? Cutting back on Starbucks, maybe one less vodka at the pool party in Miami. I don't need the new iPhone 12 when my iPhone 11 is not broken. Go out and buy some Apple stock instead. Everyone needs to change the whole psychology and mentality about investing in their future.
This portion of like investing, I truly agree with the power of it. The only concern I have, let's say, is the age. You said that people don't want to wait a whole lifetime to then have that $1 million, which then makes the shiny object syndrome of meme stocks and meme coins and crypto and the returns that they seem to provide becoming the new appealing thing. And a lot of novice young investors end up there, usually buying at all-time highs. How would you navigate that with my generation usually leaning towards that, but traditional finance and traditional investors just going for the S&P 500?
The quick satisfaction. We're in a generation now, we want what we want when we want it, right? I will go on Instagram, buy something for $22 and then spend $37 having it delivered to me yesterday because I have to have it. Urges last 20 minutes. Walk around the block, have a piece of chocolate, and don't worry about it. And you won't end up buying all those things that are not valuable. Okay, so this is not a get-rich-quick scheme. They need to develop a sense of discipline and consistency to be a good day trader and a good investor in the market. No one wants to wait a lifetime to make a lot of money, but they don't have to. There are successful day traders and there are unsuccessful day traders. Okay, I will happily give you a wonderful scenario. I have an academy called Wall Street Global Trading Academy. We put together, when COVID came along, 40 million new retail traders came into the market. Webull and Robinhood invited all the people who were never welcome at this party to the party. They did not include an educational component in the story. That's why me and my partner took it upon ourselves, feeling the responsibility that with our experience, it was and my platform on social media, I felt it was my responsibility to educate, motivate, and inspire the new generation of traders to become responsible, successful traders. It's very simple. The tools to be successful, I'll give you a quick analogy. There's two kinds of gamblers. If you've ever been to, I'm sure everybody here has gone to Vegas, Macau, wherever you may go to gamble. There's two kinds of gamblers. There's one who goes to Vegas with $1,000. They have a plan. I'm gonna play my $1,000. If I make 1,000, I'm gonna walk away from the table. I'm gonna go have a steak at Ruth Chris, take my kids to see Elton John, and I'm gonna go back to my hotel room and sit by the pool. That's a disciplined, successful gambler. An unsuccessful gambler without a plan goes in with the same $1,000. He's up 1,000. He thinks he's got diamond hands. He's the greatest gambler of all time. He keeps betting. He's up 2,000, 3,000, 4,000. He doubles his bets. The next thing you know, he's down to zero. He's been to the ATM 3 times. He's out $8,000. He's sitting out on the corner smoking Lucky Strikes and drinking Hennessy, and he's afraid to call his partner because he doesn't have enough money to pay the rent. Same thing about day trading. A successful day trader will have a plan when they get into the market. Why am I buying or shorting this stock? Okay? They're going to put a stop order on every order they enter and never move that stop order if it comes toward them. They're going to start to take a profit when they can, not when they have to. If I buy 100 shares at 50, I put a stop order in down 1% from the price of the stock. If it goes to 49.5, I got stopped out. I move on to the next trade. I lost $50. I can survive that. Doesn't make me a loser. Doesn't make me a bad trader. I lost $50. If it goes to 50.5, I sell half my position. I raise my stop order to break even. Now I just made $50 and I cannot lose money on that trade. That psychology, that confidence of having made money and not be able to lose money is the most wonderful thing in the world. That confidence, that new rearrangement of your mind will make you a good trader. It goes to 51, I sell 25% more of my position. I raise my stop to 50.5, where I'm now locked in a $0.50 profit. And I do a bracket order or scaling stop order, whatever it is, and I get as much out of the trade on the upside as I can. That's a successful trader. An unsuccessful trader will have no plan. They're just going to buy it because Uncle Herbie told them to, some signal service told them to, FOMO, hype, hope, not successful trading strategies. When they buy stock, they will not have a stop order. They'll use a mental stop. I don't even know what that is, okay? They won't take a profit. They'll turn a winning trade into a losing trade. They'll watch it go to 51. They'll think, oh my God, it's going to 55. It's going to the moon. They'll never take a profit. They go get a coffee. It's trading at 48. What do they do then? They average into the stock. They buy more. It goes to 46. They buy more. It goes to 44. They can't take the pain anymore. They sell it. Inevitably, the stock goes back up $8. They blame the market maker. 3 losing trades. One of the great tools of Wall Street Global Trading Academy is when you're having know when to stop when you're making money and know when to stop when you're losing money. The irresponsible losing trader will have 3 losing trades. They're going to revenge trade. They're going to double up. I got to make it back. I can't accept a loss. Okay? And in our book, in our school, 3 losing trades. I lost 50, I lost 50, I lost 50. I turn the machine off, I go home. I'll come back from a losing day. I'll come back from a losing week. But I will not come back from a $50 loss becoming an $8,000 loss. Okay, so these are the two. I just gave you the scenario of a successful day trader and an unsuccessful. These are 5 rules that you could write on a piece of paper, put it on the wall, put it on your computer, duct tape it to your dog's behind. But watch it, read it, look at it, right? Hire someone for $50 with a 2x4, every time you do something silly, let him smack you in the back of the head.
There we go. You've been very generous with your time. I want to wrap up the episode with, you mentioned earlier on, you have a specific strategy, something about day close. I didn't quite fully catch.
Right.
If we could summarize that as we wrap up the episode.
Sure. So as a broker on the floor of the stock exchange, I have access. Okay. What's the best way to describe this? Okay, imagine that you're a hedge fund, you're an institution, you have 1 million shares of IBM to buy. In a world where the market goes up and down, it can be down 1,000 points at 11, it can be up 1,500 at 12. How do I go back to my customer and tell them why they should use me as opposed to just using an algo or using the system? As a broker, a human being on the floor of the stock exchange, in a world that's being taken over by technology, I need to give my customer a really good reason why he gave the order to me, okay, and not, okay. So imagine I'm a large institution, I have 1 million shares of IBM to buy. What would I do with it? Me as a broker who's been doing this for 40 years, I'd buy, okay, large investors want to put their order flow where there's a lot of volume. Because otherwise people will see what they're doing. They don't want to be front run. They do not want to do that. So on the opening bell of the NYSE, there's a lot of volume. On the closing bell of the NYSE, there's a lot of volume. So they will often embed their order flow on the open and the close. If I have 1 million shares to buy of IBM, I'll buy 200,000 shares on the opening. I'll put 400,000 shares in an algo, 10% from 10 o'clock to 2 o'clock. And then I'll put 400,000 to buy market on close, meaning I will execute that last 400,000 on the closing print. That way I can go back to my customer and say, he goes, what'd you do for me, Pete? I'll say, I was involved everywhere. The world, we got 2 wars going on. There's an election. Market's been up and down. It's been crazy. So I bought you a couple hundred on the opening. I bought, 400,000 over the day. So I got you some nice prices, track the consolidation of the global markets. And then I bought you 400,000 on the close. Say, great job. I'm really appreciative of that. Me, Peter Tuchman, as a broker on the floor of the exchange, I get to see all the order flow for the closing bell at 2 o'clock. It's not inside information, it's information. So it's a matter of information is a funny thing. It's just what do you do with the information? Everybody does something different with it. I've been doing this for a long time. So as a broker on the floor, okay, I am able to see that order flow for the closing bell. So I built a strategy 16 years ago so I know that markets move up or down as a function of the dollar notional value of each stock. 1 million shares of Visa is more significant in moving the market than 1 million shares of Carnival Cruise based on its price. Okay. So I worked and I built parameters. Okay. So I know that every $400 million there is to buy or sell is going to start to move the needle. Okay. So at 2 o'clock, and this is kind of proprietary, but it's also something I cannot disseminate to people except other broker dealers, right? So unfortunately, I can't share it with retail people. However, but it's what I do. So at 2 o'clock in the afternoon, my handheld computer that the stock exchange gives me populates with all the orders for the closing bell.
Okay.
So I get to see that. I will put out, I have a bit of a spectrum-y brain. I will look at the orders on my handheld, and I will estimate how many dollars there are to buy or sell at 2 o'clock. Then I will have my son and 5 other people who work for me input all these imbalances for the closing bell into a spreadsheet. What's an imbalance? Well, 500,000 to buy, 300,000 to sell means 200,000 to buy, 300 paired off. Make sense?
Yes.
Okay. So all the orders come in at 2 o'clock. They are updated every 5 minutes until 4 o'clock. Okay? So I take that information that's given to me on my handheld and I build a spreadsheet from 2 o'clock until 3:50. Okay, at 3:50, this information goes out to the public, not just the regular public, anybody who subscribes to Bloomberg, okay? So I have the information before most people, not before other brokers on the floor of the exchange. Everybody who has a seat on the exchange gets to see this. Now, I'm not at any advantage because the number is updated every 5 seconds. So $1 billion to buy at 2 o'clock can be $1 billion to sell at 2:01.
I see.
Right? So I need to be incredibly accurate with that number, okay? And impart the information to my customer and use it and trade the market accordingly, okay? Through my experience, I found that for every $400 million, there is notional dollar value to buy or sell. It will affect and move the market. So what I do is from 2 o'clock to 3:50, I will build this spreadsheet and be very accurate. My son is a bit of an idiot savant. He can type 347 stocks in 3 minutes and 16 seconds, right? So it's a function of accuracy. Who's the first person on the train? And if I'm the first person on the train with an accurate number, and I know the correlation between the dollar value and the SPY, I can trade the market from there. And so, not to get more specific than that, I am able to trade the market around that information. And that's what I do. It is a strategy. Unfortunately, it's not a disseminatable strategy because it's just information privy to those that are on the floor of the exchange. But it is, if retail traders, your audience, are wondering why the market kind of does a wild move around 2 o'clock, it's because that's when our handhelds populate. And once again, at 3 o'clock, also the market will see it. You'll see a move. If I can give anybody a little information that so that they feel like I'm giving them something special besides a little chocolate, is that at 3 o'clock and at 3:30, one should be on the. So usually the markets make a big move at 3 and 3:50, and your retail audience should know that you should rather be on the same side of the move that the market does at 3 and 3:30, rather than trying to be counterintuitive, right? So when a market sells off, as a day trader, our first impulse is to be a buyer, right? When markets sell off, you want to be a buyer, but you need to be a buyer at the right level, right? You don't just buy stock when a market's selling off because it's down $20. Let's go a quick scenario. GameStop went from $2 to 483 and back to 151. When it was trading at 483, I called I was trading it every day that day. It stopped trading 29 times that day. Okay, the day of the meme. That was one of the first meme stocks. It was trading at 483, and I called my partner and I said, David is a technical analyst, right, at Wall Street Global. He's my partner. I said, Dave, where do we buy GameStop? It went from 2 to 483. It's trading down. It's trading at 390, at 370. Where is their support? And he said to me, the next level of support is $151. And I said, you got to be kidding me, right? So you're telling me it's going to go down $300 before it hits support? And he said, technical analysis, moving averages, pivot points, RSI is telling me, right, that the next support in this stock is $151. Oh. Sure enough, it went from 483 to $150.75, right? It went down $300 and only broke David's price by a quarter, and it went up $37. That's a shout out to technical analysis. That is the power of technical analysis. Why does it work? For lots of reasons. A lot of it is because a lot of people are reading the same info. And if everybody sees the interrelationship of moving averages and RSI and all of that stuff, and you see where the support and resistance are, that it fulfills its own prophecy.
Makes sense,
Because
yeah.
everybody's on the same page. Makes
Well,
sense?
Yeah, of course. Peter, I want to say that we have a lot of fans waiting for you in the summit. So you've been very generous with your time.
It's a pleasure.
Just before, as we head off together back to
Sure.
the summit, to the camera, any final pieces of advice?
Sure. First of all, I invite anybody of your audience to go to wsgta.com, and we do live free masterclasses every month. If you go to the website, you'll see that we have an amazing course and a boot camp that's incredibly affordable, accessible, and fun. There's a money-back guarantee, there's a payment plan, there's all these things. Our secret sauce is that we coach and mentor all our students from all over the world every Thursday night. Nobody does that. So for me, I could be doing a lot of things. I could probably be vacationing, except that I'm a workaholic and I love what I do. So I wanted everyone to know that it is really important to me to share everything I know with you all who are the next generation of the investing and trading community, because this is way too much fun to keep a secret.
There we go.
Right? And so I've committed myself to that, right? I want everyone to journal their trades. I want everyone to know they learn more from failure than success. I want everyone to know that to be humble, don't be stubborn, find a mentor or a coach. If it's me, I just bring it on. I am up to the challenge to change everyone's life in a positive way. That's why I'm here. That's why I'm still doing what I do.
There we go. Peter, thank you very much. A true honor. So thank you for joining us on the show.
It's my honor. Thanks, guys.
There we go.